You're listening to the GOLDNOMICS podcast, with new episodes every month on iTunes, YouTube and SoundCloud. Subscribe to stay informed. Hello and welcome to episode 12 of the GOLDNOMICS podcast, where we look at global financial markets through the lens of precious metals. And today I'm joined yet again by CEO Stephen Flood and by Research Director Mark O'Byrne. And our title for this month's podcast even, is Financial Contagion. Why is nobody talking about these risks? And before we dive into that, I just want to remind everybody to subscribe to our podcast, either on YouTube by clicking the subscribe button down below, or if you're listening to this on iTunes or on SoundCloud or wherever you may be listening. Subscribe to our podcast and you can stay up to date with all precious metal news by signing up for our market update on goldcore.com. So we are talking about financial contagion and why nobody is talking about these risks. Mark and Steve, welcome. Steve, maybe I might start with you and say, okay, well, what risks are we talking about? I suppose it's all things risks we're going to be discussing today. So what are we talking about when we're talking about financial contagion risk?
Well, it's a mouthful. I know. We just spent the last 25 minutes trying to figure out what to call our podcast because it's not an easy one to really talk about. But we actually think it's really, really important. And when you look at financial contagion, what you're looking at is basically the system that underpins our financial markets, our economies, where we trade, how we trade, who we trade with. What happens when that comes under pressure, under risk, and how does risk and the consequences of downturns spread through an integrated economy? And what most experts will tell you today is that the global economy is more integrated than it has ever been before. And those risks are there. And typically, if you go 10 years, 11 years, arguably, with upward stock markets where we haven't had any kind of downturn, a lot of these risks are bubbling just under the surface. They haven't been tested. You have perhaps bad credit quality sitting on the balance sheets of these banks, and then what happens if there is an event, if there's something happens in the world, God forbid a war, or maybe large pillar companies going bust all of a sudden in surprise. How does that then pass through the financial system, and what happens? And a lot of the global bank regulators are looking at this. They're looking at the capital buffers of banks and trying to ensure that they are fit for purpose and they will be able to withstand anything that should be thrown at it. But at the same time, they're also very worried because we haven't really tested the system and the models are quite old and antiquated and wouldn't be robust. And so today we're going to talk about what those risks are, what they look like, and then hopefully come around to a few ideas that people can think about in terms of managing their own risks, whether they be as individuals or as companies, and start to think about this because it's really quite serious. And if you can get ahead of it and you can be prepared and hopefully come out the other side somewhat intact.
Right, and Mark, you're looking at these through a lens. You're kind of calling them the 4 C's. What's the first one there? Counterparty risk is what you're talking about there. Maybe you might just like to explain what you mean by counterparty risk, and probably then talk about how it seems to be or where you're seeing it increasing in the markets at the moment.
Yeah, well, as counterparty risk is in an economy, there are all sorts of different actors and players, whether it be the individual consumers, SMEs, corporations, banks, and we all exchange goods and services, and we buy different things off each other and interact with each other in this modern financial economy of today. And so counterparty risk is the risk that we have to each other, in effect, in our modern economy, in terms of payments, savings, investments, and the whole gamut of across the entire spectrum of the economy, in terms of the financial side of things and economic side of things. So contagion comes from the word contagious, and obviously certain diseases are contagious and they spread from people to people. And then a contagion, you have financial contagion when it comes into markets or into economies, and that is seen when this counterparty risk is elevated, and when one counterparty does not do or not honor its contract, if you will, with the other counterparty. And I suppose the most common example of it is when they fail to make a payment, and I suppose
fail to deliver on goods as well, isn't it? I mean,
exactly. Yeah, it's the other side.
Exactly. And Stephen put it very, very well indeed, in terms of what's happening and what has happened in recent years, and how we've kicked the can down the road, and these risks are building up under the surface. But a big example of it is we were just talking before the podcast there, how these things are emerging. And a classic example is Thomas Cook, and I didn't realize the scale of the debt in Thomas Cook. It's something like over 1.4 billion pounds, something like that. Absolutely wow. Astronomical, you know, and it's seen 600,000 travelers, you know, who use their services to go on holidays, stranded all around the world, or all around Europe primarily. So 20,000 employees, and this is I suppose a classic example of it, you know, and that debt has been there for a long period of time, but it's been masked over, and it's been sort of papered over by the manipulations of the central banks in terms of the printing of money, obviously, and the transfer of the debt from the private sector onto the sovereign and the debts of the governments, but also in terms of negative interest rates and decrease in interest rates down to near zero, which has allowed these companies, some of them actually, to increase the debt even more and make them even more vulnerable, you know.
So just to break that down, like from a Thomas Cook point of view, the counterparty, you've got the holiday maker on one side, and their counterparty is Thomas Cook. So somebody books a holiday in advance and, you know, pays up their money, and ultimately the holiday, or in some instances, part of the holiday is delivered, so they get flown to wherever it is that they're getting to, and the company goes bust and they don't get flown back, or else people who have booked holidays now for a date in the future don't get their holiday delivered to them effectively at all. And what you're saying is, particularly when there is a distance, a time frame between when you initiate that contract by handing over your cash and when the delivery of that goods or services is, you are at risk to that counterparty. And that there are some things that increase that risk. And if that company has got a lot of debt and increasing leverage, that the risk that they are going to be able to deliver what they have contractually contracted to deliver to you becomes greater and greater and greater. And in that instance of Thomas Cook, it was the leverage of the company, which ultimately meant they could not deliver the services to their customers. So the counterparty risk massively increased as a result of the leverage on their balance sheet.
Absolutely, and that leverage has been there, I think, since 2007, when they were acquired by a German company, you know. So a lot of corporations are engaged in all sorts of funny business in terms of how they account for these debts, you know, and it's only now that some of this is beginning to come to light, you know. It's because we're at the top of the cycle, in effect, you know, and everything is cyclical, and everything is fine as long as we're growing and there's economic growth. Then you can sort of hide away these massive systemic issues in some of these companies, you know. But yeah, you're right, and it's not just the consumers, also the hotels were also in this counterparty risk equation, that some of these hotels are actually out of pocket in a big way as well, you know, and some of them may actually fail, and then you see them potentially seeing their employees lose their jobs, and then it filters out into the wider economy, and it creates a lack of certainty. Consumer confidence starts getting hit, and so it has a wider effect in terms of the psychology, which is all important as well.
What happens though, if you have a very long, drawn out economic growth period, and you don't have periods of contraction, which you'd naturally see, those individual contracts, let's say between the customers and Thomas Cook, and Thomas Cook and the hotel chains that they're dealing with, the margin of safety gets compressed, because the actual institutional memory for downside risks gets lost. And so everybody operates on the basis that everything's going to work out fine. And so the contracts aren't beefy. The terms of debt aren't really wide enough in order to protect under most scenarios. And what essentially, this is what Nassim Taleb had said in his book there a few years ago. He talked about fragility, which is a negative effect happening to a system. and he came up with a concept called anti-fragility. And what that means is that through difficult times, we actually become strong. And the best example of that is human beings. And we would say that, I think most people would agree that, through adversity, we become stronger. Or we learn about problems, we start understanding them, managing them correctly. And yeah, we can have down days and down weeks and down months, but those actually tend to be for the long-term benefit, because you become more robust as an individual in life. And we all want our kids to grow up that way, to be resilient. And the same is true of companies and complex systems as well. You want to have up cycles and down cycles, because that actually means that those down cycles won't be as severe and systemically relevant. And so what we've had over the last 10 years since the last global financial crisis is almost a straight line of growth, basically underpinned by free and cheap money, which is washed through the economy, which means that a lot of these counterparties actually never experience any major upsets and surprises. And Thomas Cook is a classic example. We did have actually a contagion effect there. You had a number of governments around the world stepping up very, very quickly, which is interesting, to protect their local tourism trades, like Turkey and Spain and Portugal, and these places that had all of these tourists in theater. And they knew that if this went bust, there could be a knock-on consequence to those local economies, and they were willing to offer money to support this company group so that they perhaps wouldn't collapse. In the end, they weren't able to come to an agreement, and it did collapse. But what we're looking at is that is even as a huge event, it's a small event in comparison to the financial systems that we have today and the risks that are there, because these are a magnitude greater and more involved and more connected, and will be on a transnational basis in terms of their actual spread. That, because we haven't had actually any downturns, we don't have that anti-fragility in the system. We're not as robust as people might hope or think we are, and therefore, in the financial system, we believe that the risks that are underpinning it are significant, and I think the next year and a half will be quite telling in terms of if they do come to pass, especially as interest rates go negative now. What will that do to the system?
So ultimately, what you're saying, and if we take the Thomas Cook example, you're saying that we've had such a long, protracted period of growth and low interest rates that can allow a company to massively increase their balance sheet, massively increase their leverage, and effectively massively increase the counterparty risk to all of its customers. And this wouldn't necessarily be something that their customers would be aware of.
Yeah, absolutely. And it's already having ripple effects in the wider market in terms of other tour operators and holidaymakers have actually put up their prices quite significantly already. So when a big player like this is actually found out and goes to the wall, it potentially can have quite inflationary impacts. So, and ultimately, Thomas Cook, one of the reasons that Thomas Cook have gone under in recent days is because the banks became more risk averse on the lending side. So the banks have been putting up with a lot of this and actually encouraging a lot of it, and there's been massive risk appetite. And we see that in the markets in terms of bond markets and stock markets at all-time record highs. So risk appetite has been rife. There's, animal spirits are flying. There's a lot of irrational exuberance out there, as we know, and that is beginning to change. And banks are getting more nervous, and we covered it 2 weeks ago, a week and a half ago in the market update, that the plumbing of the US financial system itself is actually coming under pressure, and the New York Federal Reserve is having to pump in billions and billions, not on a monthly basis, but on a daily basis, into the interbank lending market in these repo operations.
Well, this brings us nicely into the second C, really, doesn't it? The credit and debt crisis.
Exactly. Yeah.
So, how is that impacting us now, or what is it that we have to look out for in that, or where are the signs that we can see that this is really starting to become a risk?
Well, Thomas Cook is a sign. What's happening in New York, in the banks over there, in terms of the New York Fed stepping in. I mean, they're providing massive liquidity every single night into the marketplace, because the banks there's a bit of distrust there between some of the banks. I mean, the Deutsche Bank share price is falling again quite significantly. I know that the share price is back near record lows, not quite at record lows. This is one of the biggest banks in the world, Deutsche Bank. And there's other banks that are very vulnerable. Obviously, the Italian banks, the Greek banks, the Portuguese, Spanish, even the Irish banks all have their own issues. So
There's a
But
great
basically, the bottom line is it's the global debt, and we've spoken about this before. We actually, at the start of the year, we spoke about the risk of this global debt bubble collapsing. The global debt has actually increased this year. It's going up around 2 or 3 trillion a year. We're now up to nearly 250 trillion, which is over 320% of global GDP. So, you know, the debt is 3 times bigger, the total debt. Because sometimes people focus solely on the government debt or solely on the corporate debt or solely on the banking debt. When you look at the aggregate, it's very important to look at the aggregate and look at it holistically. The total debt to GDP ratio was 320%, you know. So it's absolutely astronomical, and it's just about manageable at 0% interest rates or negative interest rates. But if you see even a slight uptick in interest rates, or potentially you don't even need a slight uptick in interest rates, you just need a lack of confidence, a lack of trust to creep into the system, which I think we're beginning to see.
And I think the credit worthiness of that debt is probably under a lot of pressure right now with the global trade wars. You know, a lot of that debt growth is actually in Asia, and China in particular, and with the trade wars, you're
dig into that for me a bit more when you say that. A lot of the growth is there, so explain that.
The last 10, 15 years, China has gone absolutely crazy on debt. I mean, as a percentage of GDP, I think it was something like 4 or 5%. Now it's up around 30 and 40%, and it's growing rapidly. And what you have is this kind of pseudo capitalist market where you have a lot of gigantic semi-state banks and industrial bodies who may not have the exact same reporting requirements. So it's easier for them to kind of split asset from liability and obscure the liability from the asset. And so therefore it's hard to know if the reporting is accurate, how big the actual issue is. We only know what they've reported, and at that it's quite a big number. And if you look at the trade war and what's that going to happen, what's that going to do to Chinese the economy, what happens if some of these surprises come to the surface, and then what does that happen to all the counterparties that rely on those banks? You know, so it's an interesting one. There's an interesting story from the past which I'd like to bring to your attention. It was called the salad oil scandal from 1963, and it basically was a situation where a trader in New Jersey who was involved in commodities had started borrowing money against his olive oil and salad oil stocks that he had. And essentially what he would do is he would bring these ships up into New York and New Jersey, whatever, would have inspectors from the government and banks come in, and they would look at the actual big vats inside these ships and check how much oil, salad oil or olive oil he had, and they would lend money to him. And what he was doing, in fact, was he'd filled these tanks up with water and had put oil on top, and oil would float to the surface. So when they looked into the vat, they'd see a whole vat full of oil, but in fact it was only maybe the top inch had oil. And they would lend money to him on this basis. And he had worked up, what he'd figured out was he'd bring them in and they'd look at one big vat in the ship and they'd see the salad oil, and then they would go for lunch. And while they were at lunch, he was pumping the oil from one big vat into the other big vat tank in the ship. And then they'd come and have an inspection on that after lunch, and it was full of oil. Then they'd write the check to him. It turned out that when the price of oil fell, of cooking oil, I think soybeans and stuff, there was a huge crash in the 1960s. They came looking for their oil, the stock, and they realized there was none there. He had created a fraud of $1.5 billion using this scam, and it's a famous example of things not being as you might expect, and I think there's probably going to be an awful lot of stories just like that, where companies and banks are operating under false pretenses, where the liabilities are far greater than they have expressed before.
Yeah, absolutely. And in this, era of massive risk appetite, it's huge greed actually. And when you have that sort of psychology going on and that greed running rampage on Wall Street, it encourages to a degree all sorts of shenanigans and occasionally even fraud. And I think that story is I think a lot that's going on again today on the NASDAQ in terms of some of the IPOs going on in certain of these so-called tech companies, and some of the promises. They're not engaged in actual fraud, but they're actually making all sorts of crazy crazy claims that Wall Street is lapping up in terms of their growth projections, because they're transforming the consciousness of the planet, and they're doing all sorts of wonderful things that are going to generate massive profits. And then it turns out that the models just aren't fundamentally stable at all, but it's in this cycle, this greed just runs rife, and obviously the bankers are earning fees based on the projections of these companies, so there's a lot of crazy stuff going on, and some of those IPOs are being found out as we speak, and that's another sign that we're at the top of the cycle. It's like 1999, It's interesting that Thomas Cook, I just typed in Thomas Cook debt into Google, and the Thomas Cook ex-boss, he spent £2 million on a Spanish mansion just as the firm was facing collapse, So there's a lot of corruption going on out there, and that is another sign that we're right at the top of the cycle. And the accountants, sometimes the accountants are enabling a lot of this crazy nonsense as well. And I know some of the accountants are being there's a probe going on in terms of the collapse of Thomas Cook, because there's all sorts of funny accountancy going on with a lot of these companies,
Yeah, we obviously can't say anything definitively either.
No, I'm just saying a probe was launched because there are concerns in that regard, and it just you can get away with all these things as you did. It's like Enron and and AIG, the biggest insurance firm in the world. All these companies get away with this while the cycle is there. Everything's everybody just goes along to get along, and they're all getting paid their fees and all the rest. But then when things start turning and people get a little bit more risk averse, and then directors suddenly start going, oh well, there's a bit of a fiduciary duty here, hang on a second guys, and they start asking questions. And it was ultimately the banks, I think Lloyds and Royal Bank of Scotland, who I think pulled the plug on Thomas Cook.
So when the tide starts to go out, we'll see who's been swimming
exactly
with no shorts
it's
on.
all cyclical, and that's exactly it. It's about the seasons, and the to everything a season. I'm not sure, I think it's Ecclesiastes, but it's all cyclical, and we're now we're in the autumn very clearly, and we're moving from a summer and we're moving into a cold, hard winter, and it's time to get prepared.
Right, we're moving on. Our third C, currency wars. Mark, I'm going to start with you. Give us a brief synopsis of what you're talking about when you're talking about currency wars, and how this is actually, how the contagion as a result of currency wars is going to affect us.
Yeah, so it's something we've talked about since 2004, 2005, because it's just been seen throughout history, and the term has been popularized more recently by James Rickards. But basically, throughout history, nations have debased their currency. They've gone from actual gold currency, gold specie that's used in day-to-day transactions and between governments, to not backing their currencies in terms of day-to-day transactions, or indeed between nations in terms of their trading of goods and services, to have it not backed by anything whatsoever. And that's what we have today. We have fiat currencies, the dollar, the euro, pound, that are not backed by anything whatsoever. And the temptation is to live beyond your means, and to spend money that you don't have, and to debase the currency. And that's been seen throughout history, and it's seen again recently in terms of quantitative easing is obviously a form of that, and the destruction of the central bank's balance sheets around the world, which they're trying to reduce right now. And all the talk has been of quantitative tightening, and now it looks like we're going to quantitative easing again. So currency wars are basically, it's almost when it becomes a tool of the nation state, whereby it becomes policy. They want a weaker currency because they are under pressure economically in terms of economic growth. They need to maintain their exports in order to maintain their jobs, and in order to compete with the Chinas and all the other economic blocks in the world, the US as an example, but whatever nation it is, they're all competing with each other ultimately in terms of getting that market share and getting their economies going. So they want a weaker currency because that maintains their economic growth, maintains their exports and their export growth in particular. So, but ultimately it's a race to the bottom, as we know and as seen throughout history, and it's a very dangerous phenomenon as well, and it will lead to inflation in time. The question is when, and the scale of the debt we've alluded before might actually lead to deflationary pressures in the short term, but all roads, I think, in the medium and long term will lead to inflation and stagflation.
Steve?
I think Mark Carney, the Bank of England the head of the Bank of England there, Jackson Hole, recently spoke about currencies, and this is his farewell speech. He's about to move on from that role, and he took the opportunity basically to, I think, to kind of alert everybody as to what's happening with the global currencies. And he spoke about the dollar and and its exorbitant privilege, as I think was it the French finance minister is famed to have said. Essentially, when you're Giscard or whatever his name is, and
Giscard d'Estaing,
Giscard, basically, what he was saying is that there is a huge privilege when you're a reserve currency, but also what happens is that you tend to connect the risks in your economy with the rest of the world, which may not actually have any real proximity to those risks through your currency. So you're transmitting risks. And so what happens in America and what happens with American trade practices suddenly becomes Asia's problem or Brazil's problem. And you could see that in the oil price as well. And what he was saying is that we're transitioning obviously away from the dollar. I think most people accept that that's happening. But who's going to be the next reserve currency? It doesn't look like the euro is going to take that mantle. But it does look like China might. And because they're growing, it's the second biggest economy in the world now. And so if it does, what does that mean for the rest of the world? How much power do we place in the hands of that political entity? And that's obviously a concern for a lot of people. He was suggesting, though, that maybe now is the time to look at this fringe cryptocurrency movement and think if there are elements of that we could use inside the next reserve currency of the world. So he's way ahead of this conversation, and he's bringing it to the table of the most powerful today. And so you might find is that these currency wars, which arguably have had huge negative consequences for lots of economies around the world, and it's particularly in the worker, the actual worker and the family finances of people in these countries has been terribly affected by currency devaluations. He's saying that perhaps we need to have this global currency, and it will be managed on a cryptographic basis, which would remove the ability, or at least very much limit the ability of political actors, i.e. central bankers, because they are political actors for the most part, as far as I'm concerned. It would limit their ability to devalue their currencies for political aim and economic aim on a short-term basis, and that would probably give a huge amount of stability to the world. I absolutely agree with that. I think most reasonable people would agree with that, and I think it was interesting he said that at Jackson Hole on his farewell speech.
Because with the mantle of global reserve currency that the dollar has had for the last number of years, last couple of decades, I mean, with that comes a responsibility, because there's immense power effectively given to you when you are the global reserve currency. And if that now seems to be shifting away from that, and you're saying that China as the second, as a second largest and one of the fastest growing economies could take over that mantle, you then start to say, right, well, there's an immense power that comes with that. And while you may not agree, or maybe you do agree with everything that's going on in American politics at the moment and the current administration, you have to say that their politics is an awful lot more aligned with the rest of the Western world than the politics of China. So there's probably a lot of geopolitical tension that is going to be created as a result of this migration of global currency status from west to east. Would you agree with that?
Yeah, yeah, absolutely. I can see that already. There's huge tensions there. And initially, it was more about Russia and the West versus Russia, whereas recently, it's very much China's on the radar, and that whole détente that we've had in recent years has gone, and we're in a Cold War, and hopefully it doesn't. Stephen mentioned war at the start of the podcast. Hopefully it doesn't descend like a lot of Cold Wars have done throughout history. They can descend into hot wars, and trade wars tend to lead to currency wars, tend to lead to actual wars, and so hopefully, and given you know, the idiocy of some of the political leaders we have today. There's a lot of spoofery and a lot of big talk, and that's the sort of dangerous stuff. You need actual, you know, calm, rational heads and people to talk and to jaw, not to war. You know, with the likes of Johnson and Trump and all the rest, it is a dangerous time. Just one thing on terms of Carney and the Bank of England, I wouldn't trust them as far as I throw them, to tell you the truth. So you know, the notion that these central banks are going
Don't
to
sit in the fence there, Mark. Tell us what you really think.
Yeah, I have to. So the notion that the central banks will create this global cryptocurrency that we should all trust, a fiat, will be another fiat currency, given value by the order diktats of these central bankers, the people who've gotten us into this mess, and then we're going to trust them that they're going to maintain the value of that. Sure, who's to say they won't increase the value of that 10 or 20% per annum as well? You know, why would we trust them? Hang on, I haven't even finished the point yet. Now let me finish the point. So the point is, why would we give them that trust, given the breach of trust we've seen in recent years? Why wouldn't we go back to the gold standard or some form of gold standard? We know the supply of gold increased at 1.52% per annum. So let's have a global gold-backed cryptocurrency, and I think that's potentially a way it should go, which is not a million miles away from what he said, but there was no mention of gold. And I think what he's suggesting is trying to push us away from gold, because they realize gold is a real threat. And if the Chinese and Russians do back their currencies with gold, they will force the West to react, you know. So yeah. Anyway,
I wasn't commenting on it. I wasn't passing judgment on terms of whether we should trust central bankers and their ability to manage monetary systems. I was just saying it was in terms of there's a shift in the perspective from who's going to take the next reserve, who's going to be the next reserve currency holder after the dollar. And so it's not going, because people don't want it necessarily to be China, and they are looking at these new technologies as a way of perhaps dealing with some of those issues. And so we don't actually have a unipolar world where one country calls the shots. It will become an arrangement across all countries and their central banks.
We do have a version of that with the euro, and it hasn't really worked out so well. So I think having one currency and one monetary policy, the different countries at different stages of their economic evolution and at different stages of their cycle. We spoke about cycles earlier in the conversation. Well, you know, you need different currency, different monetary policies at different stages of evolution and different stages of the cycle. You know, but that's not to say that you could have some form of, you know, intergovernment currency, or so there's a play. I'm not saying you should completely rule it out, and that's silly. I understand where you're coming from. It does make sense in some ways, but I think ultimately we need an ecosystem of a range of different currencies. Both.
Yeah, but he didn't rule out gold. He didn't rule out gold or anything else. He said that you would have a collective where they work on a cryptocurrency. They borrow from some of the cryptocurrencies and they use it. I mean, it could be backed by gold. It could be backed by some trade. It could be backed by deposits. It could be backed by other foreign exchanges or whatever it is. I think
if there was any plans whatsoever of backing by gold, gold would have been mentioned. And Carney has been quite anti-gold over the years, and he's very much a Keynesian and very much an uber Keynesian who is all about printing money in quite a big way, you know. So hence my concerns about trusting his pronunciations and his declared goals in this matter.
The fourth C, gentlemen, and it is probably brought on by the three C's we've talked about before. The three C's so far have been counterparty risk, and we talked about that in depth and used the Thomas Cook as the example. The credit and debt crisis, and then currency wars, which we've been talking about for the last few minutes. And the fourth C that you have on your list here is contagion. Contagion is probably as a result of the three that come before it, and how these have a tendency to spread across countries, economies, globally. So contagion as a risk, Steve.
So, well, contagion, obviously the interconnected nature of these economies is key, you know, and so, you know, right now for the last few years, you're seeing Brexit, you're seeing that's an event that has potential massive contagion risk for all those economies that touch the UK and UK relies upon and supplies and supports. So it's asking big questions of those countries and what they do, and the answer is to obviously reduce risk, spread your dependencies across multiple different counterparties, so that if there is a contagion risk, it's not going to reach a point that it becomes ruinous to you or your company, or your industry and or your economy. And the idea is that banks have done this for years. They don't want to, you probably from your time in banks, Dave, you'll know that they never like too many deposits from one single entity. They want to spread it out. And when deposits become too concentrated, it becomes a massive issue for a bank. You can't build a business on that. So I think for people listening, looking at Contagion, how is that going to affect? It depends where the risk comes from, and there's an awful lot of places that it could happen in. And I would think that what the rule of thumb is diversification. Within your assets, with your investments, with the people you deal with. It's hard for people to diversify their income, but it's something that they need to probably also think about in terms of what would happen if their employer was to come under pressure. What would they do as a family? Do they have savings? Do they have other alternatives? Do you have other skills and things that you can do? So the same rationale in terms of understanding contagion risk and having a response to it can be applied to your own individual situation.
Mark?
Yeah, well said. Yeah, it's I mean, it's about the systemic risk. The entire system is interconnected, and as we've alluded to in the podcast, there is quite a degree of risk there, given the scale of debt, in these individual companies and at the national level, and indeed at the household level. Individual consumers, they've huge car debt and student debt and mortgages and credit card debt, and it's just at all-time record highs. So from a sort of financial point of view, there's two risks. One is on the investment side, in terms of companies do go bankrupt, and that's a reality. And when that happens, or they can see their profits massively eroded and disappear, and that's when stock markets come off quite sharply, and then governments can get into difficulties. And that's when their bond prices come under pressure. So gold has no counterparty risk, and that's what's fundamental. And people sometimes don't understand gold, but it's when you buy a share, you're dependent on the performance of the company and all the personas and actors and stakeholders in that company. And similarly, when you buy a government bond, you're dependent on the performance of the politicians, the bankers, the bureaucrats, and the nation as a whole. So if they don't perform, you have that risk. Whereas you buy gold, you have eliminated that risk if you own it in the safest ways possible. So in terms of counterparty risk, if you own a gold ETF, an exchange traded fund, you've actually, in some ways, you've almost increased the risk, because you have a line of different counterparties between you and your asset. And there are custodians and sub-custodians and all sorts of banks, some of whom are have exposure, shall we say, and have risk, shall we say. So you need to own gold in the safest way possible, eliminate that counterparty risk. It's funny, I mentioned AIG before, and Enron. AIG was one of the biggest insurance companies in the world. When they went bankrupt, actually some of the exchange-traded funds, exchange-traded commodities became illiquid for a period of time, because people were saying, well, they're not insured. They hadn't actually insured these exchange-traded funds. So you're buying a product, a financial product, that and you're a shareholder, a creditor in effect, in this trust, this quite complex financial vehicle with all the counterparty risk that entails, as said, custodians, sub-custodians, and promoters. So that's one reason why ETFs are great if you're taking a punt on gold, going long, going short, maybe hedging something else in terms of the gold price. Great, you're getting exposure to gold price, but you're not getting exposure to actual physical gold. So I think that's a fundamental thing with counterparty risk. And also on the digital side of things, there's quite a degree of digital risk in the world today, and technological risk that we didn't have so much. We had it 10, 15 years ago, but today it's even much more. And I think Stephen's going to speak to this briefly. When you own gold, you want to own the actual underlying physical asset, and you want to have direct line of sight and access to it and liquidity. And we spoke about this in our last podcast, the SAFE, Safe podcast. So, but if you own it on a platform gold or digital gold, then your only point of access with your gold is via their platform and their website and their servers and all the rest of it. There is a degree of risk there. Wouldn't you agree, Stephen?
Yeah, listen, I mean, I think, you know, how many podcasts we've done, lads? I mean, you know, 9 or 10 or something at this stage. And if those listening don't own gold at this stage, you know, I don't know what we could possibly say to alert you to the importance of having it. It's for those who do own it, I think the importance is to own it the right way. Speculators, absolutely, it's about getting in there as cheaply as possible, holding as cheaply as possible. There's great ways of doing that. Some of the digital gold platforms are well capable of managing that kind of business. But if you're owning gold because of systemic risk, don't be I think brought, you know, hooked in on those cheap rates or those ridiculous offers like a free storage or anything like that, because, you know, if you pay peanuts you get monkeys, as they say. And you know, owning and holding gold the right way requires security, it requires insurance, it requires checks and balances. They have a cost. You're paying for that, and that's exactly what you need, because those measures are going to be there, going to protect you in those extreme circumstances. And you know, for a lot of our clients, you know, what I'll tell them is, you know, if you have you know, 500,000 gold sitting in Zurich, as a company, as you know, as a family office, or anything else, as an individual, you can pledge that in order to release cash and liquidity. It becomes the most valuable of collateral assets you could possibly pledge in extreme circumstances. And it's very important that you have something that is legally straightforward and has legal proximity to you, and you can direct it as you wish, and you're not caught up in some contract that prevents you from moving your gold or directing it to anybody else. And an awful lot, I'd say probably maybe anywhere 70 to 80% of the gold out there these days is probably held in systems that aren't really fit for purpose in those extreme events. And it's important that people realize that you have to have it physical, you have to have it non-bank, and you have to have it in a safe jurisdiction, and you have to have it segregated and allocated. And if you do that, then things like counterparty risk, they don't reduce to zero, but they reduce very close to it. You know, it's not, a bank with a bad mortgage book is not going to necessarily have an effect on your holding. When it comes to credit risk, you're holding it directly. It's on your balance sheet, so you have very little credit risk. And you know, the headwinds that come from currency wars and you know, economies contracting all over the world. Again, you're having it in safe jurisdictions, and not your own jurisdiction. Maybe some in your own jurisdiction and some in a safe jurisdiction. So it's important to have it properly, and have it. It has to be all weather. You know, as Ray Dalio says in the most famous bond or investor in the world, one of the most famous and most successful. He has about 7.5% of his all-weather portfolio in physical gold, and it's very, very important that you take maybe a signal from him in that regard. This is not something that's you know, it's going to always go up or always go down, but hopefully if everything else is going down, it's taking the sting out of that correction.
Mark, so you guys, you primarily deal in physical gold bullion, and that's either delivered to clients or that is stored on their behalf. And you deal with individual investors, you deal with family offices, you deal with pensions. You deal a lot these days with people who are transferring their gold out of other ways in which it is held, whether that be ETFs or digital gold, and you're storing that on their behalf. What's the best way for people to have that conversation with you today if they want to get in touch and have that conversation and talk about their options?
Yeah, well, we're very hands-on, and we're very accessible, and we like talking to people, and we actually do what we call consultations, client consultations, because it's fundamentally important to understand exactly what the motivations of the client are. You know, what are their concerns? What are the risks? What are the challenges they face? Where do they live? How old are they? You know, what's their risk appetite? And we go through this consultation, which is, they find it very, very valuable as well. And so basically, yeah, just reach out to us, send us an email, info@goldcore.com or support@goldcore.com, or ring us on our Irish, UK, or US phone numbers, and we can talk you through it. You know, I mean, we have a huge amount of collateral up on the website which answers a lot of these questions, as we've covered in a lot of these our podcasts as well. But you know, obviously on our website we do the daily market updates, which covers a lot of the issues we talked about here. We have lots of guides there as well, so if people want to drill down into the, you know, why possibly you should be considering Switzerland or Zurich as a location to store your gold, there's a guide there to essential guide to storing gold in Switzerland. So we've covered all these topics over the years, and made it as intelligible to people as they can, because people just unfortunately the media doesn't tend to cover gold for a variety of reasons, which we might look at on another podcast, because I think it's quite interesting, quite important. So, and the experts don't cover it. So the financial advisors out there are telling people to have a diversified portfolio, a balanced portfolio of equities and bonds, your fixed income bonds, which are now, as Stephen calls them, fixed costs bonds. You could have 45% of your portfolio very balanced, which will have a negative yield. I mean, and the world has just fundamentally changed. It's been turned on its head. The financial world we know it, the investment world as we know it, but the financial advisors and the so-called experts, and indeed much of the media, don't seem to realize the ramifications of negative interest rates. So it is quite fundamental. But anyway, I strayed from your question, but
no, you got it there. And Steve, I'll just add one thing I left off that list as well, is you deal with companies as well, companies who are interested in buying gold. What are you seeing as the major motivation for companies in buying gold these days?
Yeah, well, yesterday I could not stop smiling. I had a conference call with a very important bank, actually, and they were talking about taking on gold, and they were having a conversation internally, and they were mentioning the name of our company, and one of the head guys, one of the board members, turned around and said that he was already a customer of Goldcore, and he knew all about our company, knew how, you know, why owning gold was important, and so it was great to see, you know, and it made the conversation easier. Yeah, and listen, companies are very worried. A lot of cash. Companies have a huge amount of cash on their balance sheets right now, especially the large ones, and I think that's it's near records, and they're not deploying it as much as possible as it would normally do. So owning gold is like owning another currency. It's part of a treasury management strategy. You don't want to have too much currency in your local financial apparatus, especially with the big risk of bail-ins. And people don't realize this. I mean, it's not even discussed, but every single treasurer of any company out there needs to have a strategy to deal with bail-ins. And that means basically that if the bank was to find itself in trouble, part of the recapitalization would require people's deposits and companies' deposits to be used to recapitalize that bank, and your cash would be removed over the weekend. And so if you're only protected over 100,000, being a company doesn't necessarily protect you. Being an individual protects you up to 100,000, but above that, it's open season. So as a company, if you have reserves of $1 million, 2 million, 3 million, you absolutely should look at putting maybe whatever the 3 or 4 year money that you don't need into something like gold. You have to have gold anyway, but you can see it and look at it as part of as a currency, as another currency on your risk matrix, and allocate some of your holdings to precious metals.
Great points. I'll just say one thing on that as well, because it's fundamental in terms of counterparty risk is the risk with bail-ins now, and it's important to realise that government guarantee, as Stephen said, it's 100,000 in the European Union, but that 100,000 so-called government guarantee, a lot of the governments are insolvent, so I don't know how well you can accept a guarantee from an insolvent government. And it's interesting, in the UK the guarantee was actually £250,000 quietly in the House of Parliament, House of Commons. One evening it was reduced to £100,000, and now I believe it's £80,000. So that arbitrary 100,000 that you have throughout the European Union, it depends on how much money they need to bail in in the bailout. So if they need, in bailing out the banks, they need X amount of billions, they're going to potentially, and most likely I think, decrease the 100,000 to 80,000 or 50,000. So it's completely arbitrary. It could change, and that's why a lot of people think, oh, I'm going to have 100,000 in these 8 different banks, 800,000, I'm absolutely fine. You're not, you know, and companies as well, as Stephen was saying. So it makes owning that 5-10% in gold, just an absolute no-brainer, you know.
And also, just in terms of one of the major things they used to hold gold back as a safe haven asset investment is that they used to compare it to treasuries, which is government bonds from the US government or some other safe government like the bank, the UK government. And a bond might pay you 1% per year. And so you're getting something approximating inflation or official inflation back. So it wasn't necessarily cost you. But now those bonds are actually going to cost you negative 1% or negative 0.5%. So if you put 100,000 in, you're going to get less back. So now when you look at that and you look at gold as an alternative, you know, gold does have a small cost in terms of storage. But in terms of its potential upside, I think it's a very strong case today that you wouldn't have maybe had any other year up until now in recent years to own gold as an alternative to bonds because of that negative return that you get on bonds.
So own gold as an alternative to bonds. That's Steve. That's your final point there. And Mark, yours was 5% or 10% of your portfolio in gold is as close to a no-brainer these days.
Absolutely, as an alternative to deposits and indeed stocks and bonds. Yeah. It's both on the investment side and the savings side that people need to be diversified, because when you talk about contagion, it will impact both investments and savings, you know, across the spectrum.
Okay, so today we've been talking about the risks that other people are not talking about, and they're the 4 C's as you guys identified them, which is counterparty risk, credit and debit risk. We've got currency wars and the risk of contagion globally into all economies, of anything from Brexit to the Chinese taking over as global currency reserves. So Mark and Steve, thank you very much again for today. Before we sign off here, I just want to remind everybody to subscribe to the GOLDNOMICS podcast on iTunes, on YouTube, and on SoundCloud. And you can sign up for our market updates covering everything precious metals on goldcore.com. This has been episode 13 of the GOLDNOMICS podcast. And
lucky for some.
Hopefully lucky for all of us. So Steve, thank you very much. Mark, thank you very much. And
thanks, David. Well done.
Cheers. Bye-bye.
Bye-bye.
Bye-bye.